Good morning. This is Carl Dakin, and this is the Successful Funding Show. This is going to be a short show today due to the fact that I have a scheduled meeting on a pitch to an investment group regarding a Christian film that is looking for some serious dollars to make a run of films. So with that, we'll get quickly into today's topic, which is investor exits. This was the topic of last week, and we got deep into this topic, but did not have an ability to finish it. And it's a very important thing. And having talked with several entrepreneurs and groups looking to raise funding, I really need to underscore the fact that putting an offer on the table that says, give me money, where it provides for receipt of the funding, but does not provide for payback of the funding, is only half of the equation. It does not get the job done. And when an investor only hears the front end of the pitch without understanding how their money, their resources are being respected, then they have to ask themselves, does this person even care about me? Do they even understand what's necessary to get me repaid? Or is this simply an entrepreneur pursuing their dream with little or no thought to anyone around them? And this may sound harsh, it may sound highly critical, but having listened to several pitches since last week's show, and having people pitch me, expecting me to hand them an investor or write them a check without any attempt to justify what they're doing, without any documentation of what they've accomplished or where they're intending to go, with the expectation that somehow, some way, they are so cool, so great, so wonderful that they deserve to be funded. And then they are angry and frustrated that someone did not write them a check. And I just have to ask myself, what world are they living in where they believe that this is all about them, all about the entrepreneur, all about the enterprise, and it fails to take into consideration the payback, the promise of a reward for use of funds going forward. So this will be, this comes up repeatedly almost all the time. And so I've written a number of articles in my instant funding newsletter, which you can see a copy of and read on LinkedIn under my profile, Carl Dakin. And I've talked about it here on this show. And I wanted to get into more detail today about an exit, which is part of your investment offer, which is the deal or deal structure that one puts on the table. And because what you put on the table as an offer is like your key introduction of yourself to an investor candidate, it leaves the investor candidate somewhat cold if they're looking at a deal that's all about you, all about the entrepreneur, all about the enterprise, and not about them. It should be the other way around. As I explain and as I teach pitching, when I start a conversation with an investor candidate, the first thing I want to know is how I can help them, how I can move the needle forward for them, how I contribute to fulfilling their mission. And if I don't know that, if I don't understand that, then I'm really not in a position to make a pinpoint, accurate type of an offer to that particular investor candidate. What I'm doing is I'm throwing up a concept for an investment, and I'm trying to see how they respond. And there's nothing really wrong with that. If I don't know the investor, I don't have their background, I don't understand where they're coming from or what motivates them, then it's okay. But I have to be careful now that I'm not saying a take it or leave it offer. This is the only way that you can do a deal with me. What I'm doing is I'm saying to the investor candidate, I'm looking for some funding. I think I can help you, but I'm in an exploratory phase right now. I'm trying to learn more about you, how I might be able to make an investment in my company and my project work to benefit you in a way that would make this an attractive offer. And so I'm in research mode, investigator mode. I got on my Sherlock Holmes hat, and I'm asking questions, collecting information in this first conversation. But because I'm being polite, I'm being professional, I'm respectful of the money of the investor candidate, even if they ultimately say, no, this doesn't match with me, we've had a good, what we would call professional conversation, and I've left a good impression with them. And the impression may be strong enough that they may take the extra step and say, this isn't for me, but I know someone that you should talk to. I think it would match up with them. And I get a warm introduction to someone I did not know. I've expanded my network, and I've done it with not just a cold call or a drive-by introduction. This is a warm introduction, which carries with it a level of endorsement by the person making the introduction. Says this, they're telling somebody they know, here's something you should take a look at. And it reflects on their reputation that they are willing to provide the name and take the action to do the introduction. So with that, we're focused on how to get to that point with the investor candidate to know what they want to see, what will motivate them enough to make the investment. And talking about the exit is where we want to start the conversation, not where we want to end the conversation, not where we want to end the pitch. Because if it's all about us, then the investor candidate has every reason to take the same self-centered, selfish attitude about their money and go, I'll go put it with somebody else who has greater respect, greater care for my money. Now, one of the things to keep in mind is that when structuring a deal, there is an automatic conflict between both the entrepreneur and their enterprise and with the investor candidate. That in any deal, they always talk about, well, what's fair? And this is quite often misinterpreted to say who's greedier, who wants to have the bigger amount of money, and that's not actually what this is about. What we're trying to do is trying to make sure that each party can maximize or optimize what they get out of the deal. And by doing that, there is the potential that one side or the other may end up making more money. And there's nothing wrong with that. That doesn't make the deal unfair or unbalanced. That's, again, a misconception in how people approach doing a deal. What we're trying to do is saying that if we go through a series of activities, a series of events, which would include the investor giving resources to the entrepreneur and the entrepreneur putting that resource or resources to work, that there will be benefits that come out of that in the success of the company. And these are both monetary, non-monetary benefits. These are all elements of what can be put into an investment offer. And some of these will be given back to the investor along with their original investment. It is a reward for having access to these particular resources. And the size of the reward is supposed to be commensurate with the level of risk, basically the competitiveness within the capital industry for this particular money. And as a result, this sets what some people would call a market price, which is a reward that's equivalent to the risk that is there. So, but when this happens, then the entrepreneur has to ask themselves, well, how much do I give up to this investor? And the more they give up, the less that is retained. There's less there to reward the entrepreneur. And the result of that is that the entrepreneur doesn't want to give up any more than they need to. And the investor is thinking, it's my money. He who has the gold makes the rules. I should get as much of this as possible. And both of those outcomes make sense. They're rational, but they have to be considered and thought about in the context of what is the price of money, what is the availability of money from other sources. And yet we see over and over again situations where money from one source is treated differently from another, where people insist upon a rate of return without really understanding what the risks are. And this lack of preparation, lack of understanding just contributes to a bad situation and a bad deal that even if it does go forward, probably may be unworkable for one or both sides. But it certainly doesn't create the common unity, the collaboration that we would like to see come out of the deal. So because I'm on a short clock this morning, we're going to end at 8:30 instead of the regular 9 o'clock time. I'm going to talk about one deal I'm working on now. This is a live offering that I've been consulting with for several months on behalf of Your America Media. This is a company run by Rick Amato, which is in a growth phase. It's elevating to the next level where a variety of different video interviewing services are being raised to a level of a news media platform that will have both live interviews, recorded interviews. It will have a newsletter, and it'll have a website, all of which will be sharing news, which is intended to be unbiased, meaning that it doesn't have a underlying agenda or an overriding agenda. It isn't distorting the truth in order to make a point or to falsify information, or as Trump would call it, fake news, which occurs on both sides of the fence. The idea is to give the viewer, the customer, information from which they can learn about what's going on in the world, and they can then draw their own conclusions or take their own sides on any particular issue that may be out there, but to do it without causing the person to have to stop and reflect and sort through what they're heard to try to get down to the real facts. So in this, a capital campaign is currently underway. It's a $500,000 maximum capital goal. And the offer deal is intended to be attractive to investors by giving them what might be the best possible structure for an investor candidate without it being unfair in terms of the ultimate allocation of money that might be made out of this opportunity. So instead of doing a loan, which is the most dominant form of investment out there, and instead of using equity, which is the second most prevalent form of investment that's out there, in this case, we're doing a revenue share. Now, for those who want to go through the finances of this, a revenue share means that a percentage of each dollar that's earned, and earned meaning paid in revenue, is set aside and distributed to the investor. And this is done before considering any cost of earning that dollar. It's intended to be money, as we call it, off the top, as opposed to off the bottom. So before expenses are figured out and paid, essentially we are putting the investor candidate first. And this has a number of very many attractive reasons to an investor candidate, because as soon as the company starts generating revenue, which could be the first day or the same day that the investment was made, there is money going back to the investor to start the repayment of their investment at that time. And so it isn't a sit and wait or sometime indefinite in the future, even though sales may not yet have occurred. But as soon as the first sales dollar crosses the threshold of the bank account, then there will be a mechanism put in place where a portion of that money, a percentage of the total revenue, to be set aside and paid to the investors. So this is similar to a royalty that might be paid on a license upon sale of a book or music or a film, but it's called revenue share. It's a contractual relationship, meaning that you've created a legal obligation to pay the investor this money, which is based on a formula set forth within the investment agreement that says just how much of revenue that's going to be. So in some ways, it's similar to a loan where there's a contractual obligation to pay back the principal of the loan with interest. But the difference between revenue share and a loan is that revenue share is based upon actual money coming in the door. And that means that it is going to parallel or be in alignment with cash flow. Whereas a loan may require a payment even when no sales have occurred, where there's inadequate sales to cover the amount of the loan payment. And a person, an entrepreneur, can find themselves upside down where they're making payments out with not enough money or not enough money coming in to make the payment. And so it has that attribute to it. On the other hand, it's more similarly aligned with an equity investment in that the payments go on over time. There is no necessarily a time cap or a dollar cap that goes along with this. If you tell someone you're going to pay them 2% of revenues and there's no other provision within the investment agreement, those 2% of revenues will continue for the life of the company in the same way that stock ownership will continue for the life of the company. The key difference between a revenue share and a equity ownership is that the revenue share is being paid before expenses, which again can create a situation where the company's upside down, and as a result, it may not be able to make all the payments would do. It may not be able to continue operations. This is the risk part of the deal. But because the investor is getting paid back early, because it's an ongoing payment tied to revenue, then the investor may see their investment come back very quickly, which increases the rate of return. The IRR or ROI on that investment goes up the quicker the money's paid back, as long as there's continuing payments going forward. Now, at this point, I recommend that every entrepreneur, every enterprise consider a revenue share arrangement as a way of creating an exit for the investor. It isn't contingent upon some event way down the road, way in the future, such as we're going to get bought out, we're going to do a second round of funding, we're going to set up a sinking fund to buy this back out of profits. This is a mechanism that has an immediate trigger tied to revenue, and therefore the time frame between the investment and the beginning of the payback is ever so much shorter. And for this reason, a lot of investors like this going down the path. Now, where some investors are not happy with revenue share or would like to think about a revenue share is that they're going, well, what if the company goes great guns? What if it becomes the next Google or Facebook? What if it blows the socks off of everybody and somebody steps in and buys this company? We participate in revenue share. We'll continue to have that participation, but it's only limited until the time the company is acquired. And then at that point, then we're cut off. So in order to introduce an element of fairness, to recognize the investor's value, if the company is acquired, which would serve to terminate the continuing payment of revenue share payments, you can put in a conversion ratio. And this is similar to a convertible note. where it's a loan at some point in the life of the note before it's paid off can be converted to equity according to a formula which is put into the loan agreement, the promissory note. And the same thing in a revenue share, we can put in a conversion ratio. It says if the company is acquired at this date, this portion of the sales proceeds from the sale of the company will go to buy off or pay back the investor candidates, giving them an upside potential that follows the value and growth of the company, while at the same time giving this investor a shorter path to payback because they get paid back as soon as revenue starts. So as I'm designing these types of offers, as I'm trying to create something that is as attractive as I can make it so that we can get an investor candidate on board, at the same time, it is also a goal to try to hold back as much of future profits, of future success for the entrepreneurial management team of the company. This is a conflict, as I said. It never goes away. There's always going to be a little bit of give and take in here if the only benefit to the investor is coming out of the payback of the investment. Now, where we have investments made, where they're impact investments, where there are benefits that exist outside of the investment in the form of maybe a supplier selling more products or a distributor selling more products or services upstream, then it may be that the greater value to the investor is outside of the money they invested. And in that case, then the whole concept of fairness and allocation takes on a completely different look. And that's going to require more time than we can get into here today to try to lay that out. But what we've done in the offering for Your America Media is we started off with a set aside of revenue of 10% to the investor. So for the first dollar and every dollar thereafter for a while, 10% of each dollar of revenue goes into a pool. This pool is divided amongst all the investors in the pool. And so if we have 10 investors who put up $50,000 apiece, that gets us to the $500,000 total. And we're sharing in 10% of the revenue, then each one of these investors who put up $50,000 is actually getting 1% of the revenue to start with. Now, over time, it's possible within the sales projections within the life of Your America Media that 10% becomes a great amount of money. And this is where we're going to put in yet another feature which is to the benefit of the entrepreneur, where we had the one feature to the benefit of the investor, which is to convert to ownership at the time of sale of the company. We're going to put in a feature for the benefit of the entrepreneur that once an investor hits a certain return on investment, then we're going to reduce the percentage of the revenue, where we started at 10%. Once the investor has doubled their money, if they put in $50,000 and they've now received distributions of $100,000, then the amount of revenue drops from 10% to 5% and continues from that point forward. And then this is called a stair step or a ladder type of structure. And then we put in yet another step, which is that at the time, an investor may earn 3 times their money. So if they put in $50,000 and they got $150,000 in distributions, then at that point, the revenue participation in all the sales falls to 2.5%. Now, we could put a cap on it at some point. We could say, once the investor receives 4 times their money, then there's no further distributions. We didn't do that in this case. The 2.5%, or the last stair step, going from 10 to 5 to 2.5, once the investor has tripled their money, then at that point in time, the revenue stream continues indefinitely. If there is an acquisition, there is a formula in place to convert this to equity so that the investor will participate in an upside that may occur from a sale of the company. But if there is none, then this is just an ongoing cash flow to the investor, which could amount to a substantial amount of money over time if the company performs as well as it's projected. So what we've done here is we've created an investor exit. We have framed it so that there's a quick payback that starts as soon as the revenue occurs within the company and continues indefinitely into the future. And at the same time, we've attempted to create the balance between the investor and the entrepreneur by saying that if the investor can double their money, then it's perfectly normal to say we should step down the percentage of revenue that's paid to that investor because they've had a success in this investment and they've doubled their money. If they triple their money, well, by that time, that's an even greater success. So we step this down again. And the net of that is that in this case, both sides are getting high value out of this. Your America Media is getting money today to expand its operations and to put out more different types of publications, which in turn will generate more revenue. So it's a direct parallel between more activities and revenue. And the investor is not having to wait for a prolonged period of time. So similar to a loan, they'll start getting payments every quarter. But in this case, it's tied to revenue, which could be greater than any amount of payment they might receive through the loan. And that's the hope of both sides. Both the entrepreneur, Rick Amato, and the investors are both hoping the company succeeds. In this case, their wishes and desires are in alignment. And we've created a structure that will attract investors to this particular opportunity that will hopefully be more attractive than a loan and more attractive than a straight equity play. It might be considered similar, and we can do comparisons with a convertible note or a safe note or some of these other types of instruments that are out there that could be a different type of deal structure. But the important part for today is that all of these have a structured exit for the investor. That is part of the offer. There is a mechanisms being put in place. There is an intent and means to pay back the investment and provide a reward to the investor. And that is what we want to accomplish when we talk to an investor before we make a pitch, is that we've got the investor in mind and we intend to take care of them and thank them for their investment. So that's it for today's Successful Funding. I've got to run to a pitch session now. We'll see you next week. Bye.